Hi guys, welcome to our new video. At first glance the comparison looks backwards. Detroit has been the headline case for tokenized real estate gone wrong. Lawsuits, local investigators calling out neglect, and a court order halting rent collection. And yet, when you map the real risks from a token investor's point of view, Humble, Texas, Houston Metro, can be the more dangerous bet. Not because of courtroom drama, but because Humble's risks are systemic, persistent, and harder to insure or price out over time. Below, we discuss the strategic reasons why Humble may be riskier than Detroit for tokenized property investors, with evidence and investor takeaways. 1. Visible legal risk, Detroit, versus systemic environmental risk, Humble. Detroit's problems are highly visible and legal. Municipal nuisance suits, allegations of unpaid taxes and building code violations, and a judge's order that has blocked eviction and rent collection for hundreds of token-linked properties. These facts matter. They interrupt cash flow and destroy short-term value. Outlier media div Humble's problem is different. It sits inside the Houston region's expanding climate and flood exposure. Recent reporting warns that vast swaths of Texas real estate face growing extreme weather risk, and the cost of that risk is already surfacing through higher insurance premiums and insurers exiting parts of the market. Those are economy-wide adjustments, not one-off legal disputes, and they can permanently raise carrying costs or make properties effectively uninsurable. That's a structural shock token holders cannot fix with better on-chain contracts. Houston Chronicle Community Impact. Why this matters: legal actions, Detroit, can be litigated, escrowed, and, in some cases, resolved or insured against. Systemic climate insurance withdrawal, Humble, can permanently reduce net yields and resale demand across whole neighborhoods. 2. Entry price, yields and margin squeeze. Many tokenized portfolio plays in Detroit relied on extremely low acquisition prices. Median sold prices in Detroit still cluster around low five figures, which allows headline yields to look high even after repairs. By contrast, Humble's new-build single-family homes and planned communities list in the high $300Ks, $400Ks range, a very different cost base. When acquisition price rises, a given dollar of rent produces a smaller percentage yield, and fixed or rising carrying costs, insurance, property taxes, HOA maintenance, eat a larger share of net returns. ZillowNewHomeSource.com. Why this matters: token platforms that market a uniform 11-17% ROI across markets are masking the math. The same fee layers and legal operational frictions compress net yield far more on higher-priced Humble homes than on extremely low-cost Detroit buys. 3. Insurance and operating cost volatility in Greater Houston. Local coverage shows insurance rate shocks in the Lake Houston, Humble area, and reports of carriers pulling back, residents scrambling to renew or pay much higher premiums. Flood insurance averages have risen, and FEMA's individualized pricing, risk rating 2.0, has increased premiums for many properties in Texas. These rising, unpredictable insurance costs act like a tax on rental yield, and in extreme cases can render properties uneconomic to operate. Community Impact Kiplinger. Why this matters: a token that pays rent but sits on a property with skyrocketing premium obligations will produce rapidly falling net returns. And if insurers stop underwriting a neighborhood, resale and financing markets dry up. 4. Liquidity, conversions and extra frictions hit Humble harder. Token holders already face cross-chain bridges, conversion spreads, gas and withdrawal fees when they try to turn on-chain dividends into cash or into major wallets. Bridges and exchange swaps carry percent-level fees, plus mainnet gas, which can range from a few dollars to dozens depending on network. Those costs are real and recurring. Bitcoin taxes, Ethereum, ETH, Blockchain Explorer. For a low-margin asset, Humble's lower cap rate after insurance taxes, the percentage taken by bridging, swapping and fiat withdrawal represents a larger share of net return. Why this matters: even if both Detroit and Humble investors face identical blockchain frictions, Humble's tighter net margins mean gas conversion hits are proportionally more damaging. 5. Market depth and exit risk. Detroit token offerings grew fast because headline yields and scarcity narratives attracted speculative interest. When reality hit, maintenance, taxes, code violations, the patch was public and litigated, but the market knew where the problem was. Humble's risk vectors, climate, insurance, regional economic exposure, are broad and affect many sellers at once. That correlation reduces the chance of a buyer stepping in for a quick exit if multiple tokenized properties in the region face the same problems. In other words, Detroit's problems are concentrated and addressable. Humble's can be correlated and systemic. WXYZ 7 News. Detroit Houston Chronicle. Practical takeaway for token investors: if you're assessing tokenized properties in Humble versus Detroit, treat them differently. For Humble, demand transparent, independent proof of insurance history and renewal terms, stress-tested net yield models, showing scenarios with higher premiums, and contingency reserves for large regional shocks. Ask whether the platform has local reinsurance arrangements and how it will handle mass claim scenarios. Community impact for Detroit: focus on title, tax payment history, the status of ongoing litigation, escrow procedures for rent, and proof that a competent local property manager is fixing code issues. Judicial actions are immediate, so confirm how rent is being handled in escrow and what remediation timelines are in place. Outlier media across both: insist on net ROI illustrations, after platform fees, maintenance reserves, conversion bridge and withdrawal costs, proof of SPV ownership via county records and audited property management reports. Bottom line, Detroit's tokenized property crisis is headline-worthy and dangerous, but it is a concentrated, legal, operational failure that can be litigated, remediated, and contained, albeit at cost. Humble's risks are stealthier, but potentially more destructive. Rising climate exposure, insurance market retreat, and higher acquisition bases create a persistent margin squeeze that chips away at returns and resale prospects. For prudent token investors, Humble can be the riskier market because its problems are systemic, correlated, and harder to insure or litigate away. If a token offer from Humble looks too neat, double-digit yields, glossy marketing, treat it as a red flag until you've verified insurance, net yields, and local governance. Tokenization is a tool. It does not erase geography or climate risk.